Market erases morning gains as key indices come sharply off the highs of the day. Uncertainty looms over the possible escalation of the Israel-Iran conflict, the strength of a China recovery and the outcome of the US elections. IT and financials continue to eke out some gains even as realty and utilities are the big drags.
Business updates of top lenders: HDFC Bank, Bajaj Finance, Bajaj Housing Finance, Bank of Baroda and Mahindra Finance paint a mixed picture. Even as retailer Avenue Supermart reports a weaker than expected sales, the stock takes cue.
Crude oil prices scale to a 5-month high as fears of Iran supplies being impacted and disruption in movement of oil via the Strait of Hormuz fuel concerns, and this even as the demand-supply balance remains comfortable.
Market mavens caution on the China rally say they did like to see stimulus translate into economic indicators like property prices. They point to previous bear market rallies in the China that fizzled out even as they remain bullish on India.
CNBC-TV18 Citizen MPC votes by a majority of 4-1 that the RBI will not cut rates in the upcoming policy on the 9th of October, but a majority of 3 out of the 5 votes that RBI must change its stance to neutral. Good afternoon, you're watching Business Lunch here on CNBC TV18. Vinny Motiwala is with me this Friday afternoon, and what a reversal we have seen from the highs of the day. It looked like it was a good afternoon for the markets, but the last 10 minutes don't look like that.
Absolutely. I was all prepared to say it's a very good afternoon. I was like, we've seen that recovery, happy Friday, but seems like that's really not the case. Whether you look at Nifty, Sensex, mid-cap, small-cap, all of them seen a sharp fall. Look at the red above us, right? I think we are almost in those shades of red, but that is, we're twinning with the shade on the screen as well. Not anything exciting coming in. Those tensions in West Asia is something that continues to
That remains a big overhang, right? And the Nifty too now down to the lowest point of the day. It was once briefly slipped below that mark of 25,100 as well. 350 points off the highs of the day. Well on course now for the worst week of 2024 is the Nifty. Until close of yesterday, the Nifty was down 3.5%. Add another 0.5% fall to that. But the picture on the screen, the 0.5% fall is not significant. What's significant is what has come off the highs of the day. Pull up the Nifty Bank as well. And that is the principal culprit that is leading this fall on the index. There's 650 points off the highs of the day is the Nifty Bank. Now 51,700 is where the index is. And the two major constituents of that as well, HDFC Bank and ICICI Bank, two very important levels to track on both of these names. 1643 is the level on HDFC Bank and 1236 is the level on ICICI Bank. If they go below those levels, they would have given up all the gains that they made in that rally starting the 11th of September. The index heavyweights, Reliance Industries as well, of course, leading the fall as well. The index heavyweights, these three have led the fall in yesterday's session as well, and they are doing the same in today's session as well. PSU Bank's IT still in the green, but significantly off the highs of the day.
Now, that's some bit of a respite there, at least some bit of a green today that we are seeing coming in only from those PSU banks and IT. But Nifty Realty, that's among a top laggard as well. So, you know, when any of the realty names that you pull up as well, whether a Godrej Properties, that's down and out, 4% decline that we're seeing, DLF, even something like Asoba, Prestige, all of them down. So Nifty Realty also is clearly seeing some bit of a pressure to take trade. A lot of individual names in terms of on the back of news flow also are seeing a fall. Let's pull up Ola Electric in terms of the discounting that they announced, especially for the festive season. That's keeping the stock under pressure, though recovered from the day's lowest point. At one point of down, it was down more than 2%. Now just down almost 1% in trade. EPAC Durables, keep an eye on that. M&M Financials, DMart, all those Q1 updates, surely that is something that is keeping the stocks also a bit under pressure. Obviously, global tensions that continues to impact the market. But what's also something that we should be watching out for, Urmas, is those FII selling numbers. Yesterday's number was quite high in terms, after a very long time, I think I saw such a high number on the screen. And that is sparking off a tension between, you know, China making that recovery, India. Now, where is that going to go, the tug of war? What is it that you're picking up, and what are we watching out here?
The sell figure yesterday was the highest in 4 years. So that was a big number that came in, almost 15,000 crore, well over 15,000 crore was the number that came in. And this FII selling, the money moving out of India into the Chinese markets has been this overhang, one of the key triggers for this fall in the market as well, this relentless selling that has come in from the FIIs. And many experts have come on our channel, they've mentioned this as well. Adrian Movat was saying this as well yesterday about money moving out of India into China. 15,243 crore was that sell figure yesterday. And there is the graphic that comes up on your screen. There you see, before heading into that holiday weekend which China is on currently, the benchmark index there was up 27% in 9 trading sessions. Almost 900 points is where it had surged from a 52-week low to a 52-week high in just 9 sessions was the Chinese market. And that shows the kind of push that the FIs have had. In the same time, when the Nifty had made its peak until close of yesterday, it was down 4%. Add some more to that after today's fall. But of course, a lot of these, and that's the contrast that you're seeing between the Indian and the Chinese markets. Now, what has happened here is, even despite this rally that you're seeing in China, not many are convinced about this. Rajiv Jain of GQG is one of them. He also mentioned that there have been many such instances in the past, but these rallies have not lasted in the Chinese market. So, well, this may be a good trading opportunity. Whether it is a 3, 4, 5-year investment is a question mark. That remains so. Citi came out with a note. They also mentioned that this rally, this outperformance has led to Chinese equities catching up with the Indian markets. But this strong macro growth, the domestic flows that India has, that remains, and that will continue to drive the Indian markets and the growth there as well. And lastly, Gavekal Research came out with a view as well. They said that even if this rally in China sustains, even then many foreign investors remain reluctant to invest over there. The headwinds in China will be tailwinds for the Indian markets, and the big thing that they say is that it is too early to say that the bull market is over in India. And lastly, a very big view that came in from a billionaire investor, Stanley Druckenmiller. He said that he has no interest in China as long as Xi Jinping is running the country. He made these remarks a couple of days ago at a conference. So all in all, the China rally continues, but there are still skeptics of this rally as to whether this will last.
Absolutely. I think one point you made also is the domestic inflows. That's quite interesting, because yesterday also domestic inflows, DI has managed to make up to that number there. So yes, interesting to watch out for. But we spoke to a whole host of experts on this point as well, India versus China. What are their thoughts on that? Listen in.
What we've seen so far is a commendable delivery on the monetary policy side. We've seen some direct stimulus at getting the equity market animal spirits back alive, and certainly the retail investor has followed through on that. What will differentiate this one is if in the next weeks and months we get some clarity from the Chinese government, from the key policymakers in the Politburo, as to the magnitude and the scale and the deployment of a large fiscal package. Because let's remember, I mean, China's single biggest problem that it faces at the moment is immense oversupply on the real estate side. And you need a sizable fiscal package aimed squarely at local governments to be able to digest that. In other words, buy it off developers and turn it into social housing projects.
Actually, I don't think it's a bad thing if China market does well for us, as in mostly for India. It is not bad for India per se. I don't think that beyond some shorter term thing, investors have to sell India to buy China. Because India, I don't think in aggregate people are overweight. They might be 1% plus minus overweight. So if you were underweight China, that would have come from the rest of the world. India and China, even an emerging market fund combined, would be, say, 20 and 25, 26 now. So half the investment of people who are able to move this around is in non-India, non-China.
Some expert opinion there on the India versus China debate, but a key sector that triggered this market fall just a few minutes ago was the FMCG index, and you can pull up that. Now it's down to the lowest point of the day, 1.5% lower is the Nifty FMCG, and almost every index constituent, HUL, ITC, Nestle, Britannia, all of them have seen very sharp falls from the highs of the day. HUL down 1.5%, recovering slightly from the lows. ITC almost down 2% from the lows. Nestle is down 2%. and all of these FMCG names are leading the losses on the index, and that has triggered the fall as well. Now, moving on, then, the government is committed to reducing the fiscal deficit, an estimated further decline to 4.9% in FY25. That's the word coming in from Finance Minister Nirmala Sitharaman, who was addressing the audience at the Kautilya Economic Conclave. She also added that they have a sustained policy focusing on India's banking sector. Listen in.
Our government continues to uphold its commitment to reducing the fiscal deficit. Aided by buoyant revenue generation, restrained revenue expenditure growth, and healthy economic activity, the fiscal deficit is estimated to decline further from 5.6% of GDP in FY24, I'm basing on provisional actuals, to 4.9% in FY25. The decline in commodity prices has facilitated the lowering of the budget allocation for subsidies on fertilizer and fuel. The soundness and resilience of India's banking sector have been underpinned by sustained policy focus on asset quality improvements, enhanced provisioning for bad loans, sustained capital adequacy, and a rise in profitability. NPA ratios are at a multi-year low, and banks have now efficient debt recovery mechanisms, ensuring that the financial system stays healthy and the cycle lasts longer is another of our core policy priorities.
India is closely watching global developments, but the government is not unduly worried even as markets face a spillover impact. That's the word coming in from a government official speaking to CNBC-TV18 Sapna Das. Sapna is joining in with us to give us more details on what she's picking up, what is the chat she had. Sapna?
Well, it's fairly known that, the Indian economy and the markets are like fairly integrated with the rest of the world. So there is bound to be some spillover effect or rather impact of the global developments at the moment. And there are many of them, so to speak, like for instance, the US Fed rate cut followed by the China stimulus, signs of recovery in the Japanese economy, and then you have the heightened escalation of conflict in the Middle East. So all of these pulls and pushes are definitely having some spillover impact as far as the Indian markets and economy is concerned. But the important point here is that the government is not unduly worried by these developments. They seem to be indicating that the Indian economy is fairly resilient, and going forward that resilience needs to be strengthened, or rather needs to be kept strengthening further. Having said that, one area where, of course, the economy is slightly vulnerable are the crude oil prices. But here again, government officials are indicating that, the current volatility in the prices are nowhere near what India has seen in the past, like, breaching $90-95 odd a barrel, even crossing $100 a barrel. So in the past also, the government has taken measures to handle that kind of volatility and, bring some relief to the common consumer, so to speak. So those tools are always there at the government's end to deal with such volatility. But the important point is that that level is nowhere to be seen as of now. Going forward, in terms of building resilience for the economy, and this is something the finance minister has also echoed, is basically one of the big tools in the hands of the government, and that's what they are doing very clearly, is sticking to the fiscal consolidation roadmap. 4.9% is what the government is aiming for this year. According to them, this leaves enough leg room for private capital to come forward and invest. So all in all, at the moment, nothing to be unduly worried about. The spillover impact is kind of natural. But going forward, the resilience in the economy, the kind of buffers that we are talking about, they need to be kept getting built in.
Sapna, thanks a lot for that update. Take a short break here on Business Lunch. Continue with our coverage of the markets and more stock-specific action on the other side. Stay tuned. We'll be right back.
Welcome back. You're watching Business Lunch on CNBC TV18. Let's move on and talk about Sachin Bansal, who founded Navi Finserv. Their FY24 annual results point to rising pressure in the fintech world, especially in the leading businesses. And that has also drawn the attention of regulator RBI. Abhishek Kothari is joining in with us to give us the key takeaways from the number. Abhishek, good afternoon.
Good afternoon. So let's take a look at Navi's FY24 numbers, which have come out, and they show a strong growth in disbursements by 27% YOY and AUM, that is asset under management, by 26% YOY. But these mask the real problems. Now, interest income on these loans are down 12% YOY, and that has impacted the net interest income as well. Despite the fact that we are in a high interest rate scenario or better yield scenario, these numbers actually optically look very weak. The net interest income is also down sharply. The credit costs have risen sharply as reflected in the provisions, which have increased by 25% YOY on account of the fact that slippages have increased more than 55% in absolute value on a YOY basis. Now, gross NPA has risen by 38% YOY. The net NPA has declined on a YOY basis, suggesting that there might be mighty write-off which has been taken into account for the net NPA to decline while gross NPA is rising. So employee expenses have also increased sharply, have declined sharply by 50%. This isn't usual for a business. Now, net profit number, if you take a look, optically looks good as it has increased more than 2x, but this includes a one-off or a sale of proceeds that they have from the stake sale in their subsidiary. The question that this raises is about the health of other fintechs and the possibility of some accidents down the road. Back to you.
Abhishek, thanks a lot for that. Some stress coming in there from the fintech space. Time for a short break. Up next, we get you all that you need to know ahead of polling that begins in the state of Haryana starting tomorrow. Back on the other side. Stay tuned. Welcome back. The state of Haryana will go to polls tomorrow. And what is the first state election since the NDA government was sworn in for its third term? Abhimanyu is here to tell us all that you need to know for the polls.
Haryana will be the first state to go to polls after the NDA 3.0 government took over. Now, the BJP and the Congress are pitted against each other in a direct fight in the state, which traditionally has elected people from the Congress party or from the INLD. The BJP, of course, came to power for the first time 10 years back, and the BJP is looking to retain power for the third time consecutively on the back of PM Modi's popularity and on the work which has been done courtesy the government schemes. On the other hand, the Congress is looking to wrest power and is going to possibly look to get back into power after a decade-long drought in the state. The Congress is charged up after winning 5 out of 10 Lok Sabha seats in the recent Lok Sabha election. Also, they are looking to gain from anti-incumbency from the BJP. The BJP, on the other hand, has already replaced several of its previous candidates to battle anti-incumbency, whereas the Congress is looking to garner votes not just on anti-incumbency but also on several other issues like unemployment, the protests against Agniveer scheme, and the issues pertaining to farmers who had earlier resorted to protests a few years back. It remains to be seen how the situation is going to pan out, even as several other parties like the Aam Aadmi Party, the JJP and the INLD are also contesting and may play the role of a kingmaker in case of a hung assembly.
Thank you so much for that, Abhimanyu. But with that, we're absolutely out of time on this edition of Business Lunch. It's a goodbye from Hormaz, myself, as well as the team who put this show together. But markets clearly in the red at the day's lowest point. Don't go anywhere. Midcap Radar up next.